And the top line for demand was 21.6 million barrels per day in the United States in February. This is the highest for any single month all the way back to August 2005.
Welcome to an episode of Strategic Conversations. We host insightful discussions with top business leaders. Today, we are hosting Dr. Dean Foreman, the Chief Economist for API. It is a national trade association that represents all aspects of America's oil and natural gas industry. Dr. Foreman will be a speaker at the Houston Strategy Forum's upcoming Upstream Symposium, and we are excited to host him. I am Ravi, Kathuria, the president of the Houston Strategy Forum and author of the management and leadership book, How Cohesive is Your Company, and author of the book, Happy Soul, Hungry Mind. Strategic Conversations is hosted by the Houston Strategy Forum. If you value these conversations, please hit like and subscribe to the Houston Strategy Forum's YouTube channel. Today's episode is sponsored by Cohegic, my management consulting and executive coaching firm. Thank you for joining us today, and we are looking forward to a great discussion with Dr. Dean Foreman. Dean, thank you, sir. Thank you for taking the time to be on our strategic conversations today, and thank you for being a part of our upcoming Upstream Symposium on April 6th.
Thanks, Ravi. Glad to be here, and I look forward to both the event and this conversation.
Absolutely. Sir, let's jump right into what the theme of this Upstream Symposium is. Our theme is preparing for the supercycle, and it's understanding the supply-demand dynamics, right? A lot of events have happened. The pandemic has happened. Recently, the Russia invasion of Ukraine has happened. But last night, there were more Houthi missiles on Saudi Arabia. All of these factors are happening, and we want to understand the supply-demand dynamics. Let's start with the demand side. Hopefully, I guess China is seeing some recurrence of COVID, but for most of the world, COVID is behind us. How does demand look? What is the demand for oil today compared to how it was pre-pandemic?
Sure. So let's compare both for the United States and globally. And you introduced API as an advocacy organization, but we're also a standard setting organization for 100 years. And most people may not know this, but we're, along with the US Energy Information Administration, a primary data source. We survey up to 90% of the industry every week, and we publish our monthly estimates 2 months ahead of EIA. So here's what I'll share with you on the demand side. We just came out on Thursday with our latest monthly statistical report that has a roll-up of these weekly survey data up to monthly estimates. And the top line for demand was 21.6 million barrels per day in the United States in February. This is the highest for any single month all the way back to August 2005. It was the highest for February, the month of February, for any February in our whole database going back to 1963.
Wow.
So pretty remarkable. Despite COVID, despite fuel switching, things have gone. As the economies come back in the US, so has petroleum demand. Now let's talk
what are the key aspects of that demand? What is driving that demand to record highs? I think that is incredible. What are the factors? Because I guess most companies have asked their employees to come back to work, but not 100% yet. Right. So there is some other factors that drive that demand. Which are those factors?
So the only thing that's meaningfully down, and even that's down just under 10% compared to the same point in 2019, is air travel and jet fuel as a result. Okay. If you can't fly, you may be more inclined to drive. So we see gasoline slightly down, by 3 to 4% roughly, slightly more in urban areas compared with rural areas, but basically not far off of where it was in 2019. And depending upon the week and month we've looked at in recent months, we've had ones where we're above that high water mark. Now, diesel fuel. With the switch to online retailing, diesel has been trending well above where it was in 2019.
Okay.
And lastly, the thing that has absolutely been killing it since COVID and accelerated again with the onset of the Omicron variant of COVID in late December is other oils. So naphtha, gas oil, propane, propylene that go into the refining and petrochemical sectors. So think films, packaging, medical plastics, every one of those COVID tests that's made out of plastic, right?
Yeah.
This is where it's coming from. And we've got 7 million barrels per day as of February of other oils. This is almost a third of US petroleum demand. That's the highest for this category on record of this bucket of intermediate products. So it's not an emissions issue. It's not a transportation issue. It's absolutely critical to the consumer goods that everybody wants and needs, partly because of COVID. Now we can go look at the global picture now to contrast that and show it's not just the US. So if we look at the US Energy and Information Administration's short-term energy outlook, the STIO as they call it, their estimate as of December was over 101 million barrels per day of global demand in December. For this quarter with some seasonality, right at 100. So 100's your magic number. They have, with the economy growing, exiting 2023, exiting next year at a record high for the world of 104 million barrels per day. So this says, with the relationship that's indelible between economic growth, oil demand, and also natural gas demand, by the way, we're seeing these global demand figures continue to ratchet up. And for consumers, it's been a bit of a boiling frog syndrome in the sense that we haven't had the supply to match with that. And the disconnect between them, by EIA's estimates as of December on a global basis, was more than 3 million barrels per day of consumption outstripping production. So when you're short by that much, that's where a lot of these upward price pressures have been rooted.
And how robust is this demand? There were some news article which said that the war in Europe will actually suppress demand. So is it going to be a meaningful suppression, or the global economy? They said because war could lead to a recession in Europe, war could lead to recession in other places, and then actually reduce demand.
Look, you never say never in this business, but the plural, as the phrase goes that Roger Brenner is famous for, the plural of anecdote is not data. So, you would expect that for Europe, this would certainly be negative in terms of demand, but it's also potentially negative in terms of supply and how those weigh in a relative sense. We have at least 3 flavors of supply concerns related to Russia, Ukraine. The first is that there could be some fiscal disruption to flows. The second, and the market has seen through a little bit of this, was that as the Biden administration put sanctions on direct flows from Russia, that there could be some collateral damage as a result of the sanctions on these flows. And the third possibility really is that Russia could absolutely use energy as a weapon and withhold some of it from global markets and profit in the process of doing so.
Yes. So, I want to get into the Russia impact of the war, the invasion, on both supply and demand. But you said something in here which caught my ear, is that as demand is growing and as demand is staying robust, right? You said we could be looking at a deficit of 3 million barrels between supply and demand, right?
Yeah, the irony is that's not could be, that's December. That's
that is happening
that's where
now.
We've been.
that is where, that's where we have been last year. And so where is the supply response? Because we have OPEC, we have the US onshore, we have the Gulf of Mexico and offshore basins all over the world. We have Brazil. Where is the supply response if we are and have been, as you say, actually, in this supply demand deficit? Who is stepping up, or who can step up?
So this is the $20 question. EIA and its estimation has really three sources stepping up. So first, they assume that OPEC will add 2.6 million barrels per day this year to the market. This is, if you look at OPEC's March oil market report, their estimate as of February is that OPEC nations have added 590,000 barrels per day, so 0.6 million barrels per day, compared to EI's assumption that over the course of this year, they will add 2.6. So that's one piece. The next piece is Russia. So among the non-OPEC bucket, EIA has Russia adding 0.9 or almost a million barrels per day this year. But refiners around the world right now, almost nobody's touching Russian crude, even at deep discounts. And you have to ask, is that likely to occur as companies and service companies also are announcing that they're pulling out? So that should be expected to have a downward impact on investment, drilling, production, and Russian production potentially goes on decline there. And the third part is the United States. So EIA has the United States this year adding 1.4 million barrels per day of total liquid supply year on year on average. Well, by API's estimates and our MSR, we started the year. So in December, crude oil production in the US was at 11.7 million barrels per day. January, it drops, it goes to 11.6. February, it stays flat, 11.6. So we've come down, we're flat so far through the first quarter. The good news is the investment in the drilling does appear to be picking up, but again, we're fighting natural decline. We're fighting what last year was a tailwind from previously drilled wells. So EIA separately estimates wells that have been drilled but not completed. And almost 1 in 3 well completions in the United States last year stemmed from a so-called DUC, a drilled but uncompleted well. So we've cut the inventory of that in half year on year. And if you're following me, what this means is if we're going to meet EIA's projections for this year of growing almost 1.5 million barrels per day, we need a heck of a lot of drilling activity accelerating. And the front end of this year so far is not front loaded. If you see no growth on the front of this year, that means you have to exit at 2.5 million barrels per day of growth or more at the end of the year to average 1.4. And right now, that's a challenge, right?
And Dean, it's amazing as you went down the EIA analysis and the three sources that you pointed out, right? The OPEC, you look at Russia and then in the US, OPEC is underproducing its quota right now, right? And so the fact that they could come back and increase spare capacity and increase production, they have not been able to do that so far, right? Or somebody may say, well, they're not doing that so far willingly, but the fact may be that many of these countries are not able to step up production because of lack of investment. They're not able to do that. The only big players, Saudi Arabia and UAE, that seem to have, I guess we know for sure that they have some spare capacity. The question is, we know UAE could increase production, but it is not clear how much Saudi Arabia can add, right? Because I understand they're close to 10.5 right now, million barrels a day. Some say they could go up to 12, but that is question mark. That's a question mark whether they can really step up to 12. I know the Aramco CEO yesterday in an interview said, yes, we can go up to 12 and stay there. But other reports say that, Saudi Arabia has never produced at 12 million for a long period of time. They have done it for a few weeks, but they cannot keep sustaining that. So there is a question mark about how much OPEC can bring to the table. Russia, as long as Vladimir Putin is president, these sanctions will stay, right? And these companies that have pulled out, there has to be a regime change in Russia for that dynamic to change. We don't know if that will happen. That is anybody's guess, right? And then you came to the US onshore, and you're absolutely right, is that the supply chain will take a long time, and they have been using all their drilled but uncompleted wells, especially in the Permian, to drive production higher. And as they run out of those, or at least as the quantity of those DUCs go down, then the question is, where is this supply going to come from? right? So we are in a supply demand deficit, and we have not yet, I've been calling all over the world. I sound like President Biden, but I've been calling all over the world for demand, for supply. I don't know where else. Who is going to come up? Who is going to step up? And if supply doesn't step up, and I have been talking to on the Upstream Symposium, I have talked to most of the speakers representing a wide swath of oil and gas companies. And my message that I received back from them is that, look, we still have to be capital disciplined. We have to listen to our investors. So we are not able to drive growth higher because of supply chain concerns, because of investor concerns. And then, there was an article in Wall Street Journal which talked about geological constraints, which says the rocks are just not there, that the other basins have already tapped, other than the Permian Basin, that the saturation rate has reached more than 50%, and these basins cannot grow production. Permian can grow, but Permian is about 45%, and soon it will cross over 50% where production starts decreasing. So is that true? Does that article have merit, where it says that geologically the US onshore is getting close to plateauing its production?
That's certainly not consistent with what EIA and others, third-party consultants, project as far as the potential for U.S. shale oil production. Now, I'll tell you what I do see as the constraints. So the Permian Basin is coming back. In EIA's assessment, if you look to its annual energy outlook, they see a lot of upside potential in the northern Great Plains, so North Dakota and Wyoming. Other basins, though, the DJ, Denver, Julesburg, Niobrara Basin, Colorado area, has had changes in state regulations that have scared off some investment, and the drilling activity has not come back anything close to what we've seen in the Permian. Yes. The New Mexico side of the Permian also has state regulatory pressures that have been difficult. So now you're left with, okay, Anadarko Basin, Oklahoma, some of Texas, that's coming back, looking reasonably good. The Eagle Ford is performing relatively well. So, on balance, you have leadership from the Permian Basin, but it's not altogether clear with infrastructure considerations on top of this bubbling up of state regulatory frameworks, plus this top-down sandwich now, if you will, between state and federal regulations, where the Biden administration has put a lot of policy constraints in place. It's not enabling and not very helpful altogether for incentivizing investment across the sector. Certainly not quickly. Many other industries needed a bit of a help getting out of the COVID recession, right? Yes. Ours has not. We pulled ourselves up by our bootstraps. Culturally, we do not ask for handouts. And you mentioned the term capital discipline, and of the very largest companies, that's always been true, actually. The big global integrateds, they've always been disciplined. That's not new. And the fact is they continue to be, and they are, large, excellent producers to high operational standards. At the same time, many of the independents that have been the engines of innovation and volumetric growth, actually, for a lot of shale oil and shale gas, many of them use the same investor speak, if you will, and code of capital discipline, returning value to shareholders. But for many of these companies, and I would say for the vast majority of companies in the United States that survived this downturn, they did so by taking on extraordinary amounts of debt. And this becomes a euphemism for, you can't say this to investors, right? I took on a lot of debt, and this has really hamstrung me as far as being able to invest to grow. But think pre-COVID. Let's go back to late 2019, early 2020. Most companies, independents, mid-size and smaller, were saying that debt and equity markets were largely closed to them at that point. And it was hard to disentangle how much of this was ESG concerns from some investment banks versus the fact that since 2015, the sector had been a relatively poor investment among S&P 500 sectors. So there you are. And then you get the debt that comes with trying to survive the downturn that began in 2020. So Bloomberg's tracking of every peer group across North America If you're looking at US oil and gas, Appalachian natural gas producers, US natural gas producers, diversified E&Ps, every one of them. By the third quarter last year, the percentage of debt on the balance sheet was over 50%. Historically, a normal average is about 1/3. If you get to 60%, it's existential. No investment bank, literally no investment bank can lend to you. And now if you look at the fourth quarter, as the price environment and operational environment improved a bit, was more constructive, every one of these sectors that they track paid down debt. So again, there are real physical workforce and supply chain issues that have prevented the sector from responding as fast as it historically could have with higher prices, reducing debt, having the cash flow to be able to invest and drill and produce has been absolutely critical. And that also adds a time lag. So I'm of the belief that, look, the US and OPEC spare capacity are the two places in the world you can go and get oil relatively quickly. The US has the ability to do it in weeks to months, but because of the after effects of the pandemic, the workforce and supply chain issues, the indebtedness, and now these headwinds on energy policy on top of it, where we still have a moratorium on drilling. We still had the proposal in the fourth quarter to all but eliminate natural gas in the power sector, when natural gas was 40% of US electricity net generation in 2020. We have proposed higher taxes. And the biggest, starkest difference now versus pre-COVID, if we're going back to 2019, we are still down the better part of 1.5 million barrels per day of crude oil production. And that might not seem like a lot, but we flipped from being in the first quarter 2 years ago, a net exporter of about 1 million barrels per day of petroleum, to being a net importer to the same amount so far this year. And that 2 million barrel per day swing is night and day. It means that refiners, if they don't have the production, they draw down inventories. It means that we are reliant on pulling barrels off of global markets. And as a result of that, to incentivize those imports into the US, our domestic prices have to come up to international levels, which is what's happened. So give or take Russia, Ukraine, where we've seen some global prices be volatile and blow out to $8 above US prices. We've had days where there's only been 60 or 30 cents per barrel difference between domestic and international prices. So this just kills, and this was one of the key lessons actually at the end of last year, December coming into January. Our refined product exports dropped by 2 million barrels per day over this period. So look, cogent energy policy means thinking through the value chain, understanding the sources of supply and demand and what's feasible. And it's great to have, and to some extent, the energy transition may be inevitable here, right? And we can be agnostic about the technologies that go and want market-based mechanisms to solve it. But if you cut off and fight the sources that enable consumers to afford that transition and cut those off in advance of actually making it through successfully, we're signing up for a lot of dependence in a period when geopolitics are really ruling some of these prices right now.
This is a fascinating discussion. I really appreciate it, and it sets up, when we on April 6th at the Upstream Symposium, our theme is preparing for the super cycle. And so you look at the supply demand equation, you look at all the investment philosophies out there, you look at the regulatory constraints that are there, you look at supply chain, you look at where supply might come from, where it will take time to come from. Eventually supply will show up, it always does, but what is that price point it will take, and what happens in the interim, right? And so we may be, or we may already be, I was about to say, we may be on the cusp of the super cycle, or we are already in the super cycle. Dean, I'm looking forward. We're all looking forward to hosting you on April 6th. That is going to be one dynamic discussion. We could have continued this. I suspect we could have taken our strategic conversation today and made it a several hour-long conversation. But we're going to save that. And on April 6th, I can't wait to host you and the other speakers on this powerful discussion, sir. I thank you for taking the time. I appreciate you, sir. And I want to thank our audience for listening in today, and hopefully you all will join us April 6th at the Upstream Symposium, where we discuss preparing for the Supercycle. Dean, Mr. Foreman, thank you, sir. Thank you for joining us today. I appreciate it.
Thanks, Ravi. Great seeing you. And I look forward to the event on April 6th.